Let's talk about investments and what you should be investing if you have $1,000 right now. Now, there are many different investment strategies and people will tell you many different things. Let's actually look at some real life examples. So Warren Buffett, who is a popular or one of the most popular investors of our time, he wasn't able to become a billionaire until 50 years, or it took him about 50 years of investing before he became a billionaire. That's example number one. The second example is of Jay Walker, who was able to get that billionaire status in just 1 year. Jay Walker actually made most of his money from Priceline in the era of the dot-com bubble, and so he made all his money, or his net worth went up really fast in less than a year. And so when that bubble crashed or popped, his net worth fell significantly. So yes, it took him a year or less than a year to get to that billionaire status or to get that net worth. But if you look at Warren Buffett, regardless of what happens to investments over the years, Warren Buffett still seems to have most of his wealth intact. So looking at this will have you thinking, well, what does Warren Buffett do differently from other investors or millionaires or billionaires like Jay Walker? And how can I apply this so I can make good financial decisions and good investments that will actually positively affect my net worth? Now, the first thing I want you to take away from this video is that even though you can work really hard for a really long time and you can make a lot of money by working hard, if that is your strategy, then once you stop working hard, whether that's by choice, you stop working, you quit, or you're forced to stop working because of some other reason, then that's going to significantly affect your net worth. It could possibly even cause you to lose a lot of money. This is why it is very important that you find a way to get your money to make more money for you while you're not actively working. This is where investments come in, and this is why you want to be investing. So investing and managing money can be difficult, but the principles that you need to follow are very simple. And if you follow a set amount of principles, you can start to grow your net worth. And so, for example, let's say you have no money right now. You have a job or you have some income stream, but you have no money saved up. This means that you're not in a position to invest today because you don't have the money to invest. So the first step would be to save some money to invest. So maybe you could try to save $1,000, which you could do in a month or 2 months or even 3 months, depending on how much you make. But now you may be looking at this and you may be saying, Eann, this is going to take me a while to save $1,000, and then it's only going to be $1,000. And if I invest only $1,000, then I'm not going to make any returns on my investment of $10,000. So why should I even bother investing or saving to invest just $1,000? And that's actually a question that many people have. They don't invest because they don't think that the amount that they can invest will yield anything significant. However, by simply saving $1,000, you'll be ahead of the pack. Now, research done year after year after year has always shown that roughly 50 to 70%, usually in the 60% range of people have less than $1,000 or more saved up. So by just saving $1,000 and having your mind set on investing that $1,000, you're actually ahead doing something that the majority of the population aren't doing. So I want you guys to think about it this way, right? You save $1,000 and you will have more money saved than around 70% of the population. If you have more money saved than 70% of the population, why spend that money on clothes, shoes, electronic gadgets, things that decrease your net worth, when you could instead invest that money and keep on growing that amount of money day by day? If you look at it like this, then you'll start to see that saving $1,000 to invest is actually a much bigger deal than you already think it is. Now, the next question that you may have is, okay, if I save $1,000 and I'm ready to invest, what should I invest in to increase my net worth or to make more money? Should I invest in stocks, bonds, ETFs, real estate, a business? What should I be investing in? And I'm going to be answering some of these questions, so stick around to the very end of this video. Now, before I go any further in this video, welcome back to the channel if you're already a subscriber. And if you're new here and you're seeing me for the very first time, my name is Eann. And on this channel, I talk a lot about ways to make money, ways to save money, ways to invest your money, credit cards, banking apps, and everything that has to do with personal finance. So if you like this video and you like these types of videos, then give this video a thumbs up. I'll really appreciate it. It's 100% free. And this way, this video can get recommended to more people on YouTube and potentially help someone out as well. Also, consider subscribing to the channel and turning on all the notifications, and that way you'll never miss an update when I post a new video on this channel, and I post videos here every single day. Now, some people will tell you not to invest in stocks because it's risky, and some may tell you not to invest in real estate because you'll have bad tenants, and some will tell you not to start a small business because 90% fail in the first 5 years. And the truth is that all investments have a downside and a upside. So let's look at real estate, for example, right? Let's say you make $100,000 per year and you're busy saving your money, and now you have $500,000 in the bank cash. That money is just sitting there. So you have some options now. You could go and you could buy an expensive luxury car or an exotic car for $150,000, or you can even buy 2 or 3 of these exotic vehicles, and then this way people will know that you actually have money and you'll feel very good about yourself. However, you could take $350,000 and you could purchase a house. You could purchase this house cash, and then every single month you'll get $2,500 in rent payments. This is now income for you. But let's say after investing in this property and renting, you realize that after a year, this isn't the investment for you, or you don't like the cons that come with real estate investing. It won't be the end of the world here. You can keep the money that you made from renting the property, and you can now put the property back on the market, and you can sell it for $350,000. Or if that property appreciated, which is highly possible, then you could even sell it for more than what you purchased it for. So in this scenario, it would be a win-win. If you sold the property and moved on, you still wouldn't have lost any money. You would have more likely gained money, and if you kept the property and you kept collecting rent payments every month for 10 to 15 years, then you would have still profited from this investment. So similarly, if you have only $1,000 to invest or $1,000 saved up right now, you should invest it as opposed to just spending it. And I know you can't spend $1,000 and purchase a home, but you can get into other investments like stocks. Now, I want to share another example which shows you how important investing is, and this is by saving your money at the bank. So if you save your money and you have money saved at the bank doesn't just keep your money in a vault somewhere and hands it to you when you need it. The bank is actually in the business of investing. That's what they do. They make money from investing. When you give your money to the bank, they give it to someone else in the form of some loan products. Maybe it's as a mortgage, maybe it's as a car note or car loan, maybe it's as a personal loan or a credit card, but the bank is always using your money to give to other people. Now, this is an investment for the bank because they charge interest on that money. So you could give the bank $1,000 and they'll take your $1,000 and they will loan it to me, and I'll have to pay them 20% in interest per year on that $1,000. And so the bank uses the money as an investment. The problem with this is that the bank doesn't normally give you any interest, and even if they do, it's 0.01%, which is really nothing. So the institution that you're trusting your money with, or that you're putting your money at and keeping your money at, is actually investing and not sharing the profits with you. And this is why I think you should go out there and you should invest your money yourself and make sure that your money works for you. This way you profit from your money because you're the one who works for your money. You're the one who works hard for this money. So don't just leave your money at the bank and let them invest your money and profit from it without sharing the profits with you. Take your money and invest it into something, and then you'll get returns from that money that you worked hard for. Now, I'm getting to what you should or what you can invest $1,000 in, but one more point I want to get across before is the point of interest rates and inflation, and actually more so inflation. So inflation is the rate at which money loses its value, and this is a continuous cycle. So every year money loses a certain amount of value, or normally money loses a certain amount of value every year, and currently the rate of inflation is right around 2%. This just simply means that whatever you're able to purchase with $10 today, next year at this time, you'll probably need $10.20 to purchase that exact same thing. So this is another reason why you don't want to save money, because most banks will offer you a low interest rate. And even if the interest rate on a savings account or deposit account is higher than normal. It's usually less than 2% or less than inflation, and so you're not really making any money, although you think you are. You're still losing money, or the value of your money is going down every single year. So with investing $1,000, you have a few options. The first option you have is to invest in bonds. Now, all investments have a risk associated with them, but bonds are usually very low risk, and I'll explain why now. So government bonds are really safe because it's the government that you're actually borrowing money from and then paying you back that money and interest. Now, the reason I like this one, or why I say this is one of the safest investments, is that for you to lose out on that investment, that would mean that the government would have to default on their loan or break that promise to pay you back your money and any interest for that. And for that to happen, I think the government would have to fail and the entire economy would have to collapse. And if we actually get to that point, then investments may be the least of your concerns then. The only problem though is that bonds tend to yield the same amount as current interest rates. So if you look at bonds right now, you will see that bonds are yielding 1% or even less than 1% per year average in returns. And then if you look 2 or 3 years ago, they were yielding 3, 4, 5% in interest. And this is because a couple of years ago, interest rates were much higher, but because of the pandemic, interest rates have been lowered. So bond yields are low right now. So once interest rates start to rise in a few years, then returns on bonds will also most likely increase as well. Now, more than likely, you don't want to just invest your money to make 1, 2, or even 3%. You want to invest and make 10% on your money or more. So let's move on to the next investment that you can do with $1,000, and this is stocks. A very good example of this would be Google. We all know Google, the business that helps us with our search results on the internet. Google, who owns YouTube, Google that owns Gmail, Google that owns a lot of things that are related to the internet. This is also a publicly traded company, and if you had invested around last year this very same time, you would now be up 90% or over 90%, almost 100% on your investments. So if you took that $1,000 last year and you invested that into Google stock, then right now you would have about $2,000 invested and you would have made almost 100% on your investment. Now, this is just one example. There are many other stocks that are popular stocks. You have Amazon, you have Facebook, which are both up by about 50% over the past 12 months. And by the way, you also have some ETFs or index funds that have returns of 50 to 70% over the last 12 months. Another very good example is Tesla stock, which if you bought it last year at this very same time, you would have paid about $130 for that stock. And as it is right now, it's worth around $670, which means you would have made over 500% in profits. So if you had invested $1,000 into Tesla this time last year, you would now be sitting on 5 times that money, which is over $5,000. Now, this isn't financial advice. I'm not telling you to invest in any of these stocks and you'll get 500% or more in profits. And you should definitely consult with a financial advisor before you invest. And some of these results are typical, but if you're following along, I just mentioned that bonds yield 1% or less right now, and stocks yield over 100% easily. And so you may be wondering, why would I even consider investing in bonds? And the answer is that bonds are, in my opinion, fail-proof. Stocks, on the other hand, although you can make a lot of money and make over 100% in returns in the short term, stocks are unpredictable, and the price of stocks are very unpredictable because if a company is doing well and then they start reporting negative earnings, then the stock price will go down. If a company loses money, the stock will go down. Even if nothing really changes about the company and there is just some bad news going around about the company or about that particular industry, then that stock price can and most likely will go down. So the higher the rewards in investing, the higher the risk will be, so keep that in mind. I also want you guys to also understand that some companies are already well established with well-established products, and so the stock prices may not fluctuate as much as new or growing companies. So for example, let's compare 2 companies. Let's compare Apple and Tesla. So Apple already has a customer base. They already have their lineup of products which they update every year, and because of this, they don't really have that much room to grow. So the stock increased by over 50%, and in the same time, Tesla's stock went up by over 500% because Tesla is a newer company and they have more growth or more things that they can accomplish. And so they have more room to grow, and this means that the stock has the potential to go much higher. So with newer companies, they have more room to grow, and they'll possibly yield you a lot more returns than the well-established companies in a shorter period of time. However, the risk is the factor that you want to consider here, because the well-established company like Apple may release a product that people don't like, they hate the product, and they get some bad press for that. And so the stock price may go down, which is probably going to only be temporary, but the new company can create a product that completely fails, and then that lowers or crashes the price of the stock all the way down. So those are two more important things to consider when you're trying to invest that first $1,000. So you really have to think about how much risk you are able to tolerate before you actually put your money in any investment. And if you save $1,000 to invest and that's the only money you have to invest right now, then I wouldn't put all that money in a high risk investment. I would invest somewhere in the middle where I'm taking medium amounts of risk, where the rewards will be worth it, and also where the chances of me losing all my money isn't so high. So most investors, and not only new investors, but a lot of investors, will choose to, instead of investing in single stocks, they'll invest in index funds. And the most popular index fund that you probably have heard a lot about before on YouTube is the S&P 500. And this is an index fund that has the top 500 US companies at any time. This way you purchase one index fund and you're invested into all these companies, and this minimizes the risk of you losing money or a lot of money, because if one company or stock goes down, you have another 499 companies, and most of these companies are probably going to have positive returns on their stocks. Now, this index fund in particular is very popular because since 1920, it has averaged a positive return of almost 10% per year after year. Now remember guys, we spoke about inflation before, which was right about 2%. So you definitely don't want to invest in anything that's going to yield you a return of 2 or 3%, because you'll barely be covering inflation. And then you also probably don't want to go to investments that could potentially yield you over 100% or even over 50% right off the bat, because those are very high risk. And if this is your first $1,000 that you'll be investing, I think 10% in returns per year is a very good position in the middle for you if you just have $1,000 to invest right now. Now, if you want to invest $1,000 into index funds, it's really simple in 2021. It's very easy, and we have something called an ETF, which tracks index funds. This you can purchase with an online broker or an app on your phone, and you can get the same results, and this is what I do as well. So for example, you could sign up for Webull, and I left the link below in the description to Webull, where you could invest $1,000. You could search for the S&P 500, and you'll probably find the Vanguard S&P 500, and then you can invest your money into that, and that way you'd be investing in the top 500 companies in the US at any time. This is also easy because the app or these investment apps are free, or at least the one that I'm talking about right now is free, and you don't pay any fees and they don't charge you to withdraw your money. It's also an affiliate link, so if you sign up using that link, you'll get 2 free stocks, which are random stocks that could be worth up to $1,600. So if you watched the movie The Wolf of Wall Street, you'll remember that the guy that starred that movie, he had to call people and get them to purchase the stocks, or he had people calling him to purchase stocks, and that isn't the case anymore. In 2021, you can just use your phone, deposit some money, and you're invested in any ETF or any stock that you want to be in. So if you have $1,000 right now and you're wondering what you should invest your first $1,000 in, I would say invest in an ETF, which just tracks an index fund like the S&P 500, where you have medium risk and medium rewards. I hope this video was helpful, and this helps you to understand the factors that you should consider when you want to invest your first $1,000 and how to also go about doing this. If you have any questions, comment below and let me know what they are. As always, guys, thanks for watching. Be sure to give this video a thumbs up if you like the content, subscribe to the channel, and turn on all the notifications, and that way you'll be able to get the updates every day when I post videos. And I'll see you guys tomorrow in the next one.